So this is Chapter 8, Corporate Taxation, Formation, Reorganization, and Liquidation. Learning objectives for this chapter is to determine the tax consequences of corporate formation, identify different forms of taxable and tax-deferred acquisitions, determine tax consequences of a corporate acquisition, and then determine tax consequences of a liquidation. When we're talking about tax-deferred transfers of property to a corporation, we're referencing IRC Code 351, Tax Deferral Requirements. In order for it to be a tax-deferred transfer of property, you must transfer the property to the corporation, not just services alone. You must also transfer it in exchange for stock in the corporation. Receipt of boot triggers a gain, but not a loss, and boot is non-qualifying property received by a shareholder. And then finally, the transferors of the property must be in control of the corporation immediately after the transfer. Control is defined as 80% or more of the corporation's stock, voting stock, and each class of non-voting stock. Receipt of boot triggers a gain up to the fair market value of the boot. Boot is also allocated based on the fair market value of the properties transferred. The character of the gain recognized depends on the nature of the asset transferred on which the gain is recognized. So, computing the tax basis of stock in a transfer of Section 351 when boot is received. So actually we're going to start with a few formulas for this. So the very first formula from Chapter 8 is computing a gain or loss realized in a property transaction. Amount realized or received less the adjusted tax basis in the property transferred equals your gain or loss realized. But there are two formulas that you have to know before that, which is computing the amount realized in a property transaction. It's cash received plus fair market value of any other property received plus liabilities assumed by the corporation, less selling expenses incurred in the transaction, and less liabilities assumed by a transferor on other properties received in exchange equals amount realized. And then computing the adjusted tax basis equals acquisition basis plus capital improvements less depreciation equals adjusted tax basis. So let's work on a problem from the book. Example 8-1. This can be found in Chapter 8. Make this slightly bigger. So, as part of the incorporation of 360 Air, Alpine will transfer inventory of building and land for the corporation in exchange for 50% of the corporate shares. The property has the following fair market values and adjusted basis. The corporation will assume a $75,000 mortgage attached to the land, and the fair market value of the 360 stock that Al will receive is $300,000. How much net gain or loss will Al realize in the transaction? So first we must compute amount realized or received. So stock received, fair market value, and they told us in the problem it was $300,000. So they received, and then go back here, we can check our fair market value of property received plus liabilities assumed by the corporation. I believe they assumed a liability. Plus liabilities assumed by corporation, and that was a $75,000 mortgage. We ran through this whole thing. Cash received, 0. They didn't receive any cash in this transaction. Plus liabilities, less selling expenses, 0, less mortgage liabilities assumed by transfer or he didn't assume any liabilities, so amount realized equals the sum of this. We don't need to compute the adjusted basis because they gave it to us, so now we must compute the realized gain or loss. And that is amount received realized or received, which we just calculated, less adjusted tax basis in property transferred. So we're going to take a negative adjusted basis, and this is the amount of gain or loss realized. So this is when you transfer property in exchange for stock to a corporation. So the entire gain or loss realized would be recognized unless it is deferred based on some other IRC code or section. So at this point, we would have to look into whether or not it qualifies for any other IRC, whether it qualifies to be tax deferred. Continuing on with our problem, let's assume that Al meets the tax law requirements to defer recognizing the $200,000 gain. What would be that he transfers to 360 Air? The fair market value of the stock he received in exchange is $300,000. What would be Al's basis in the stock he received? So this is the formula for computing a tax basis in stock received in a Section 351 transaction. Cash contributed plus adjusted tax basis and property transferred plus any gain recognized on the transfer less fair market value of boot received less liabilities assumed by the corporation on property contributed equals the tax basis in the stock received. Let's go back to our problem. Assume Al meets the tax law requirements for deferring the recognition of the $200,000 gain, which means it's a 351 transaction. The fair market value that he receives is $300,000. So we are going to compute the tax basis. Tax basis in Section 351 transaction. So we take cash received. We didn't receive any cash. Plus, cash contributed. Plus adjusted tax basis of property transferred. And our adjusted tax basis of property transferred is $175,000. Go back to our formula. Plus gain recognized on the transfer. There was no gain recognized, it was deferred. Less fair market value of boot received. There was no boot received. Less liabilities assumed by the corporation. Which is 75,000. I'll subtract that. Equals basis in stock. Add these all up. And the basis in the stock is actually $100,000 on the $300,000 stock fair market value stock that he received. Now we're going to assume that Al realized a $100,000 loss on this transfer of the property instead of a gain that was deferred. He also must defer the loss, but in order to do this, we must take the fair market value of stock received, which was $300,000, plus deferred loss, which was $100,000, equals his basis in the stock. So technically his basis in the stock would be $400,000. If he went ahead and sold it for the $300,000, then that's when he would recognize the loss. So computing tax on a basis of a stock in a Section 351 transaction when boot is received, this is the formula that I read to you already. Cash contributed plus tax basis of other property contributed plus a gain recognized on the transfer minus fair market value of boot received minus liabilities assumed by the corporation would equal the tax basis of the stock received. So let's do an example of this. Now let's assume that as part of the incorporation of 360 Air, Ginny received 10% of the stock valued at $60,000 in exchange for her services for setting up the corporation. Will Ginny defer the recognition of the $60,000 gain she would realize in the transaction? The answer is no, because transfer of just services doesn't qualify for deferred gain for Section 351. Ginny's gain would be the whole $60,000. Now let's suppose that Ginny received 10% of the stock valued at $60,000 in exchange for catchphrases that she will create provide the company with a distinctive logo. Assume her tax basis in the catchphrases is zero because she created it. Will Ginny defer the recognition? Yes, because intangible assets are considered property for Section 351. So she would defer the whole amount. Okay, so now let's assume that Al received 40 shares of 360 stock with a fair market value of $315,000 plus $60,000 in return for his transfer of inventory, a building, and land. The property transferred had the following fair market value and adjusted basis. All right. So first we must compute what amount of gain does Al recognize? On the receipt of his $60,000 boot, and what is the characterization? What is the character of the gain, ordinary or Section 1231? Okay, so now we're going to compute the amount received or realized. Cash received. Stock received. He's received $315,000 worth of stock. Liabilities assumed by the corporation. So we are going to add this up. There are no liabilities here, so So there were no selling expenses, no liabilities assumed by Al, so the amount realized is $450,000. To calculate the gain, we take the amount received less the adjusted basis in the property so the amount of gain recognized will be the lesser of the amount of gain realized or boot received. The amount of gain realized is this. The boot received is the cash. So we're going to take the lesser amount of gain recognized. So the next question is, what is the characterization of this? So we're going to ask, we're going to go up here and we're going to do percentage of gain. And the way that we calculate the percentage of gain is we take the fair market value and divide that by the total value of the property transferred, F4. And then I'm going to make this a percentage. And basically I'm just going to drag down this formula and then gain to be allocated. So I'm going to allocate the gain to this. So basically I calculated the percentage and now I'm going to multiply this by the $60,000 gain. I'm hitting F4 so I can drag down the formula. Multiply it by the 7%. So this should equal our total gain, which is correct. And so what amount will be ordinary and what amount will be section 1231? This is ordinary because it's on inventory, which is ordinary. And this is section 1231. And section 1231 refers to property. Section 1231 gain. So 4,000 will be ordinary, and section 1231 will be the remaining difference, or $56,000. So now let's assume that this example, that Al received the $60,000 and recognizes the gain on the exchange. What would be Al's tax basis in the stock? So Cass contributed was none. Adjusted tax basis of the property was $175,000. Gain recognized on the transfer, which is $60,000, less fair market value of the boot received, which was $60,000, less liabilities assumed by the corporation, equals $175,000 is the basis in the stock. So I'm going to end this video here, and I'll cover the more of Chapter 8 in another video.